Welcome to the Financial Advisor's Advisor, the podcast offering guidance and advice on all things concerning financial advisors, RIAs, and the practitioners. Brought to you by Elite Consulting Partners, it's the go-to podcast for any financial advisor in the wealth management business. Learn more and subscribe today at eliteconsultingpartners.com/podcast. And now, here's your host, Frank LaRosa.
Hey, everybody. This is Frank LaRosa, CEO of Elite Consulting Partners. I am the Financial Advisor's Advisor. Welcome to the show. As always, I'm here with my trusted compadre, Dale Dempsey. What's up?
Good morning, everyone. Having a great morning so far.
Saturday morning.
Yeah.
What's on the agenda for today?
Soccer, and then music lessons. Yeah.
It's like herding cats watching soccer at that age.
Yeah, 5 and 7 it is. In fact, they have 4 fields going at once, so
That's a lot of noise.
yeah, it's a lot. Yeah.
That's good.
A lot of laughter. It's fun.
Have
Yeah.
fun with that. We'd rather be here on a Saturday sometimes. Hey, but thanks for joining us. We are excited about today's topic. Today, we're going to talk about what some view as a almost like a dirty word, and that is lending. You know, we talk to advisors all the time, and they complain that their managers want them to do lending, and oh my God, it's pushing it down our throats. When in reality, leading with lending, which is the term I like to use, can be really advantageous to the business. And so today, we wanted to really just go over sort of the 3 reasons why leading with lending or having lending as a component of your asset gathering practice makes a lot of sense. So the 3 primary reasons, and we have some notes here. We're going to go back and forth every once in a while. But the primary reasons are, 1, it's a way to increase your assets. 2, it's a way to increase your revenue on your assets. And 3, it's a client retention tool, an asset retention tool. And so I think it's those 3 components. If you look at lending that way, it makes a ton of sense to incorporate that into your business. So in terms of increased client assets, right? And you hear this all the time talking about guys that Merrill or wherever they are, and they have a lot of assets. They have a lending book. A lot of it's margin. And for this topic, we're not really talking about margin. We're not really talking about mortgage business. A lot of people think lending mortgages. That's a great service to offer to a client, but that's not what we're really talking about. And we're not really even talking about margin. And so maybe I'll just take a step back and explain sort of a brief, high-level difference between margin and the type of lending I'm talking about, which is really non-purpose loans. They're still using equity. Both of them are using your equity positions or your fixed income positions as collateral. But the real difference between margin and non-purpose loans is your release rates. So the amount of money that the firm, the institution, is going to lend you against your stock positions or fixed income positions. So with margin, it's 50%, right? So you got $1 million equity portfolio, they're going to lend you 50% of that, right? So up to $500,000. If it's a non-purpose loan, typically on equity position. So non-purpose means you're not using the money to go out and buy more stock, to buy bonds. You're using the money, you're taking it out of the firm, and you're going to go buy real estate. You're going to go buy a new business venture. You're going to reinvest those dollars in something else other than the stock market.
Less volatility.
Less volatility. They don't want you to take a non-purpose loan and then have the money come back in, which is one of the reasons why firms will always look at the origin of the funds that you're depositing. They want to know where's the money coming from. So that's a whole nother topic.
So it's not mortgage. These are asset-backed loans, non-purpose loans.
Non-purpose loans. And so, again, with margin, with equities, you get a 50% release. A non-purpose loan, you can get up to, and some banks, some firms tweak that a little bit based on their level of conservativeness or whatever, but typically up to 65% release.
Okay.
So
$1 million, you're getting
$650 instead of $500, right? Yeah. If you have fixed income, treasuries, munis, those types of things, less volatile, generally, not always, but generally, most institutions will release up to 80 to 85%. So much higher release rates. And your loan, the rate is typically lower than a margin rate. So it's going to be based off of LIBOR. It could be LIBOR plus 1, LIBOR plus 50. However, it depends on how big the loan is, right? The bigger the loan, the more competitive the firms are willing to be on those rates. And so that's sort of the high level, margin versus non-purpose loans.
Mortgages versus, right, when you say lending, that's what we're really talking about.
Again, I'm not talking about mortgages. Mortgages is a great service to offer to your clients, but it's not necessarily going to help you bring in a ton of assets like what I've seen, because your house is the collateral.
Well,
right?
So are you talking about, you're talking about existing clients. Are you talking about, can you use this to prospect?
Yeah, actually, that's a great point. And so you can use this strategy in going after lending for your existing clients, but it's also a great way to go after prospects that have a lot of wealth. And the idea here and how this helps you bring assets in is when you're going to a client and they want to buy a building and they need $1 million, and let's say they have $1 million with you, and it's all in stocks, right? So your firm is gonna lend them up to $500,000. You're gonna give them a pretty good rate, but that still doesn't get them to the $1 million that they need to borrow for the building. But they have this, it doesn't matter the institution, Wells Fargo account where they have $3 million. So now you're going to have this conversation with your client about, look, we can get you to the million at a favorable rate, but we need you to bring over that Wells account because that'll get us the release rates that we need with some cushion, right? You don't want to borrow as a client. You don't want to borrow right up to those release rates, because if the market corrects or something, then you're going to have a margin call. You're going to have a call on the loan. So when you tell the client, yeah, no problem, we're going to still get you a great rate. You just have to move over that $3 million Wells account. They do it, right? And now all of a sudden, you got $3 million in new assets that, by the way, get to go into managed money or some conservative advisory portfolio where you start collecting a fee on, which sort of gets to the number two, which is jumped ahead a little bit. Number two, about how do you make money? It increases your revenue because you get that stuff.
Point number one. Right. So how to increase your revenue.
Right.
Okay.
Point number one is the asset part, right? Which leads into number two. But to answer your question though about
really prospecting
is it's the same principle. So you have somebody in your circle that is a wealthy individual, and maybe you're not comfortable asking them. They have a $5 million or $10 million Merrill Lynch account. But everyone's coming to them saying, oh, I'm a better asset manager than that guy, or I can manage your money better. That person has heard that all the time. What they haven't heard is, hey, look, Bob, I'd like to do something for you. The next time you want to review your loan rates, because most likely those clients, wealthy clients, borrow money, especially now when interest rates are so low. And by the way, they're going to be doing it more and more because as interest rates, they know the interest rates are going to start to tick up. They're going to want to lock in some low rate loans right now and invest those dollars because they know what they can turn on that money when they're investing. As a business owner, I know what I can do if I invest X amount of dollars in the business. I know what the turn is going to be, right? So you're going to go to that client, Bob, and say, I'd like to, the next time you are looking through this stuff, I'd like to be able to compete for your loan business. And I think I can help lower your rates. So if you ever want to review your loan sheet, let me know and I'll see what I can do.
You think most clients,
most wealthy clients, when they're being offered by somebody to help lower their rate on a loan, are going to take them up on it.
That was my question.
Why wouldn't they? Right? Yeah, if you can lower my rate by 0.5 point on $5 million or $3 million or whatever it is, it's significant dollars. So you're sort of flipping the conversation. You're not asking them for their assets, right? You're not asking them to give you something. You're actually asking to give them something, which is a lower rate and saving money.
You're helping them, potentially helping
them, right? Sure. And even if they give the information and the other firm is giving them a great rate, it's competitive, which is great. There's nothing wrong with saying, hey, Bob, you got a great rate there. I don't really want to put you through the hassle to save you, 10 basis points. Might not be worth it for you. Let him know that. They might give you the loan business anyway because you were honest about it. But That's a great way to bring over assets. And so to get to number two, and you've heard this a lot, where you're telling these advisors that are complaining that they have a lot of loans and they're not getting paid on it.
Right. Oh yeah. Yeah. I mean, look, we commonly say don't worry about the lending, the loans. It's more or less a loss leader, because you're going to get new assets if you're doing lending, no matter where you are.
Right.
Right.
Yeah. So we don't want you to focus on, oh, well, I'm not doing lending because my firm's not paying me on it. That's a very short-sighted, or what I call like small ball, the way to look at things. You will get paid on it because, as we discussed in point one, if you bring over new assets, if you bring over $1 million or $5 million, I've had situations with some advisors that I've managed, well, we've brought over $40 million, right? Because the client wanted to take out a huge loan, and in order to get the loan that they needed, they had to move $40 million from their Wells account, where we knew they had 150, right? So he moved over 40. That $40 million went into advisory accounts where the advisor was getting paid, 75 basis points, wherever the fee was at the time. So when you bring over when you bring over those assets, they're not sticking that money that they're borrowing against in cash. They're investing it because they hopefully are going to get a better rate of return than the lending rate that they're using. And so you're getting paid on that. That's how you're going to get paid. The other way you're going to get paid, which is almost like by default. So in this scenario where you have $1 million with your client and they want to borrow, they need $500,000 to pay for something, whatever it is. Instead of them liquidating half of the $1 million account that you're collecting 1.5% on,
sure,
right? They borrow the $500,000
right
against the account, and now you've helped them, you've given them a good rate, and you're still collecting your 1.5% on the $1 million or the $500,000 that would have been lost. So you are making money. You're preserving your revenue. It's
sure,
like preserving and gaining.
Yeah, it's like preservation on one front, client retention. We sort of haven't talked about that yet, but
yeah,
sounds like those two things are happening. As long if you're lending, if you're in that conversation all the time, you're doing very well for your practice in terms of
absolutely
the client's happy, you're maintaining your revenue, you're adding value. Okay,
right. And so number 3 is client retention. This is one of those where a lot of times you don't see it until it's too late, right? You get that call from your client saying, "Hey Dale, I love you and you've done a great job, but I got to take that $5 million away from you because the guy at Merrill is going to give me this great rate. I'm buying a building and I need the loan, and he's provided me with LIBOR whatever 50." And then you're scrambling to figure out, can you get it done? Meanwhile, he's already gone through the process with the guy at Merrill, and you're out. And so by not offering or even talking to your client about this stuff, letting them know you do it, you're leaving your flank open, right? You're leaving an opening for your competitors to have that conversation. Because especially like if you have wealthy clients where they have operating accounts at banks, and which is where they usually are, every time that client walks into the bank, and I know it happens to me sometimes, not that I'm wealthy, but it happens to me, a business owner, they're looking for ways to capture more of my business. Hey, can we offer you a loan? Blah, 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 right? It's happening to your clients everywhere they go. And if you're not doing it, someone else is going to do it.
Yeah, you need to be in the conversation with the client at the very least.
That's a great way to put it, Dale. You need to be in the conversation. And so here's what I have found is the best way to be in that conversation. Just call your client, talk to your client or your prospect, whatever it is. But let's just say for this topic, your client. And you say, "Hey, Dale, just wanted to one last thing before we get off the phone. I know you do a lot of lending. I know you're really active in real estate or whatever. I'd like to just ask you a favor, which I think will really benefit you. The next time you have a need for a loan, I'd like to compete for that business. I'm not saying I can better the rate. I can help you with that potentially, and I can look at your loans. But the next time something comes up where you want to borrow some money, I'd like you to just think about me and give me an opportunity to compete for that business." They're never going to say, "No, that's not happening." They're going to go, "Okay, I'll do that." I mean, I've had those situations where we had an advisor do that on more than one occasion. And, weeks later, the client comes back and says, okay, I need some money. I'm not going to get into some of the details because it's sort of a recognizable individual, but had the conversation, client came back, the exact scenario, brought in a ton of money and did a huge loan. And so it's just a real simple question. I'd like to compete for that business the next time it comes up.
Is it the same question if you're prospecting?
If you're prospecting, it's almost the same question. Hey, Dale, this is great. The game is great. The conversation will come up. Hey, I know you just bought that, that new building over on, 5th Street or whatever you want to talk to them about is say, hey, look, the next time, I don't know if you know, but my firm can really handle a lot of lending opportunities. So if you'd like, the next time you have an opportunity, I'd like to compete for that business and maybe I can give you a better rate than you're currently getting. You never know. I'd like to be able to help you out with that.
Yeah, it sounds pretty straightforward and simple. I don't know. So wait, why wouldn't most advisors do this?
Right. I know. It's crazy. So most advisors that shun the lending conversation is because they think it's gonna, if the client doesn't get the rate that they want, it's gonna piss the client off. It's not like signing one form, right? There's paperwork that has to be done, and maybe the rate isn't as great, and they're gonna get, and they're worried that the client's gonna get pissed off.
But don't most clients know? I mean, if they're doing lending, they know there's paperwork involved.
Right. Yeah, exactly. So, which is what I tell these guys.
Put yourself in the client's shoes.
Right. Put yourself in the client's shoes. These are smart people. They're wealthy for a reason. They're not wealthy because they're dumb. They understand, like to your point, lending is done through, a banking institution. There's paperwork involved, and it takes some time. So what I advise advisors, as the financial advisor's advisor, what I advise advisors to do is just manage the expectations of the client so that you are involved every step of the way, that there's going to be some, hurdles that you work through, won't be a problem. You'll work with them on that. You'll do what you can as the advisor to make that process as easy as possible for them. That's all they're looking for. They don't want it to encompass their entire day. So if they know that you're working on it on their behalf, it makes them feel better. And look, at the end of the day, even if your firm, so you get this opportunity, client does all this stuff and your firm just comes back with a rate that's higher than the current rate that he has. Okay. At least you tried. At least you showed value. At least you can position it like, hey, Dale, we went through this and I'll be honest with you, I think you have a better rate where you are today. I appreciate the opportunity, but right now I would advise just keeping the loan where you have it today.
One, you're in the conversation. Two, you're giving them good advice.
Giving them great advice. Right.
If there's a third point in there, but
you're adding value. You're adding value, right? And so, that's a conversation sometimes that they have. They're always wondering, as a business owner, you're always wondering, are the rates that I'm paying the best rates out there? And so now you've checked the box for your client that, yes, check, your rates are pretty good. So that's my shtick about leading with lending. I think it's really important. I think if you focus on this as a way of gathering assets, doing it the right way, it's easily, I call it a $50 million question. You can easily bring in $50 million in new assets if you just ask the question the right way, make sure you get your lending folks, make sure the people that are going to be doing the business understand that you're going to make this a core part of your practice so that they're willing to sort of, run through walls to get stuff done for you, for your clients. Bring them into the mix. But it's what I call the $50 million question. So that's that. Thanks a lot for joining us today. We hope you can take this information, bring it back to your practice, go talk about it, be an evangelist about lending, and bring in $50 million or more.
And thanks for returning to everybody who has. Send us emails, questions. That's where we got on this topic. Share us, go to our
website, eliteconsultingpartners.com, Spotify, iTunes, wherever else people listen to their podcasts. Our website, YouTube.
Call me directly on my phone line. Everybody knows the number by now.
856-316-4653.
Or Frank is 4651.
Anyway, thanks guys. We appreciate it.
Have a great day.
See you next week. Bye-bye.
You've been listening to the Financial Advisors Advisor Podcast, brought to you by Elite Consulting Partners, the leading experts in advisor transitions, succession planning, and broker-dealer and RIA M&A consulting. If you're looking for strategic advice or solutions on any of those topics within the financial services industry, or you just want to subscribe to the podcast, head on over to EliteConsultingPartners.com.